Bit of focus on the bond market now with Ashley Dickinson, head of fixed income trading over at Renaissance Capital. Thanks so much, Ashley, for joining us this morning. Let's get straight into it because soaring EU bond yields have become the feature of the markets. Yesterday, Spanish bond yields hitting their highest level since 1997, and more so than anything else, it's that absolute magnitude that's been shocking the markets in a very big way. What's your analysis of all that's been playing out on that end?
Absolutely. I think that the Eurozone's been a concern globally for quite some time now. But I think when we're seeing the actual events unfolding, the magnitude of the problem starts to present itself even more meaningfully. As you quite rightly mentioned, Spanish bonds, the highest level they've seen since the advent of the Eurozone in any event, up almost 7%. You put that in perspective with a lot of the emerging markets. You've got a first world bond now trading there or thereabouts. Even with the ECB in the market doing a bit of buyback on Spain and Italy, and then France coming to the market at the same time, they paid almost 50 basis points more for 5-year paper from October. They were up near 282% on their issues. So all around, it's not a great story. And then you had the German Chancellor coming to the market and saying she didn't believe that the ECB should be used as a backstop. I think were her exact words. She says it's actually wrong and illegal to expect the ECB or European Central Bank to guarantee sovereign debt over there. So there are all sorts of issues cropping up now that obviously are going to impact on global debt markets.
Ashley, what's your view on the ECB's role and the role that they should be playing in the bond market right now?
It's a difficult one. Yeah, I think one of the commentators came out straight afterwards and said simply she's wrong. The ECB probably has a moral and, it has definitely a moral, but probably an obligation to get involved and support all of the ECB nations. But it's a very difficult political situation as well as a financial one. So there's no easy answer to that one, Alishia.
Okay, well, what it has done, as you say, is it's focused attention on debt levels of many countries, and South Africa has been included in that basket as well. I mean, the IMF this week warning South Africa of the implications if no cap on spending is introduced. What did you make of that warning that's been put out there?
Listen, it's a fair enough warning, but I think we've got to look at our own fiscal disciplines, our history and current track record. It certainly is a concern, but we're well within those self-imposed limits. As far as I'm aware, we've looked at a 50% as a percentage of GDP, spending to GDP. We're well within that currently. There obviously are the risks, and I think you've got to look a little deeper into the complexities and say, are the risks that spending gets out of control? I don't think so. I think our fiscal discipline and fiscal management is good. But what can be a problem is the other side of the equation being growth. We've seen the MPC on the last couple of meetings coming out with reduced growth expectations, and that's probably the higher risk, not necessarily spending. If the growth comes in at under 3.1%, then by default your spending as a percentage of that grows. So I think that's the risk, and maybe the IMF should have been a little clearer on that.
So you're a little bit more confident in South Africa's fiscal discipline from here on out, especially where we've had the finance minister put a cap on that debt level. What I think 43% was placed on that cap. You're a little bit more confident than the likes of the IMF, safe to say, and Moodys as well.
Let's take the Moodys statement and sort of unpack that one as well. We're not really that surprised. All of the points they made, fiscal discipline, deficits, political risks, etc., they're valid. And obviously the concern is that once you've put out a warning that there is a risk of a credit downgrade, we don't necessarily believe that that's the case. But just to take Moodys on the merits of what they said, all of the points are valid. We can't actually argue those. But even if the worst case scenario does occur, which I think is possibly what you're alluding to, that just puts Moody's rating on South Africa in line with Standard & Poor's and with Fitch. So it's not necessarily a train smash. The worst case scenario is not bad there. But from the IMF's perspective, they have put out the warning. Maybe they should have just been a little clearer. I'm not saying that I believe that our fiscal discipline is strong enough to assure that we're not going to go beyond that 43%. All I'm saying is that the risk is probably more on the growth side than on fiscal indiscipline.
So with the focus being on the growth side of the economy. I mean, we've had government bonds weakening slightly yesterday, also yields firmer in what traders were labeling a mild correction, in a market that might have gone overboard, pricing in the chance of a further domestic interest rate cut down the line. Where do you stand in that regard?
Yeah, I think that we saw that when the governor came out with her statement, I think it was last week, you had to read into that and possibly, we're not looking for a cut. I don't think that that's a distinct possibility anytime soon. And I think she has mentioned the risks being external as well as a couple of the internal. Yeah. But, I think where she pointed out that a potential meltdown in the Eurozone is what then directly impacts on our growth scenario, obviously them being our biggest trade partner currently. So I think she has mentioned that as a risk. And if you read between the lines, yeah, the potential or possibility of a rate cut down the road is reduced somewhat.